Strongman Personal Finance. Today, we're going to talk about a very special stock. An amazing stock that's going to 10x in like 5 days, bro. Why? Because Wall Street Bets is talking about it, of course. Yes, that forum is still a thing. The subreddit, excuse me. So, we're going to talk about ContextLogic today. They couldn't even do a space. It's just ContextLogic, also known as Wish stock. What does this stock do? Well, it goes down massively. It's been down 84% since it IPO'd. It engages in the operation of an online marketplace. There's no competition there. That includes geek, mama, home, cute, and joyful shopping. It was founded by Peter Skalbaka and Danny Yang in June 2010 and is headquartered in San Francisco. So it's full of freaking liberals. So let's look at some of the metrics, the hot metrics, okay? Market cap, $2.3 billion company. Revenue, $2.5 billion. Whoa! It's got a price to sales ratio below 1. That's pretty shocking for a growth stock. Net income, look at that hot profit, ladies and gentlemen. Negative $872 million lost over the last 12 months. Wow, that's amazing. Gross profit, I actually have a decent gross profit. I don't know how that compares to a retailer, of 55%. Let's compare that to Amazon. Let's go look at Amazon. See what their gross profit is. 25. Not bad. Let's look at Alibaba. See what their gross profit is. 38. And then if you do a brick and mortar retailer like Walmart, we'll see what they have. 25%. So they actually have higher gross margins than other companies. However, their gross margin is decreasing, as you'll see in a second. So overall, initially, I'm not impressed. Market cap, seems pretty high for a massively unprofitable company, and is losing money hand over fist. Let's see. Free cash flow margin, negative 35%. Profit margin, negative 33%. Now, the biggest thing that shocked me was the revenue growth. The revenue is barely growing. For a new, exciting growth company, the revenue's freaking trash, okay? The revenue should be growing 50, 60, 70%, Even Tesla, which I freaking hate, at least has high revenue growth, okay? There's literally nothing about this stock that seems appealing to me. Let's go look at the financial statements, all right? We'll start with the balance sheet. Now, the first thing I noticed is this account on the equity section called accumulated deficit. Normally, there's this thing called retained earnings. Retained earnings is your accumulated profits over the life of your company, minus any dividends paid to shareholders. However, if you see accumulated deficit in the shareholders' equity section, that actually tells you that they've been running losses consistently. For this company, this amazing Wall Street Bets company, oh my God, almost $2.5 billion of accumulated deficit. So they have lost over the course of their life $2.5 billion freaking dollars. Okay, I think that's more than their freaking market cap. Now, how did I discover this company? Of course, Wall Street Bets. But there's this website called memebergterminal.com. So you can go here and you can search stocks that are trending on all these stupid websites. You can do Wall Street Bets, where all the idiots hang out. R SPACs, what if Meatspin hang? R Penny Stocks, home of scoundrels. R Short Squeeze, it's probably where Lafufu gets his stocks from. And all these other stupid stocks. But this is where you can research it. So if you click in Wall Street Bets here, you can see some of the trending stocks. GameStop, The Spy, Tesla, Apple, Chewy, blah, 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 blah. And if you go down a little bit, you see Wish, ContextLogic. Now, I've been wanting to make a video about this for a while, but it's just such a stupid stock, it's almost not even worth my time. Now, let's go back and look at some more financial information to show you how freaking trash this company is, okay? Now, here I did some vertical and horizontal analysis. Vertical analysis is in green, horizontal analysis is in blue. Vertical analysis tells us, if you're looking at the income statement, all your expenses and different margins as a percentage of revenue. It's a quick way to calculate profit margins on all different levels of the income statement and to show you what expenses are generally costing the most money for the business. You can also look and do horizontal analysis, which is comparing year over year to show you changes in every single line item on the income statement. For example, vertical analysis. Revenue in 2021 for the 3 months ended September 30th was $368, I think that's $1 million. And they had $201 million as cost of revenue. That's cost of goods sold, leaving their gross profit to be $167. Their gross profit is 45%. Okay, that's pretty high. So remember, looking at the Everything Money software, it was 55, but it's going down, and it's probably going to approach what other retailers charge. I don't see this company blowing other massive retailers out of the water in the long run. Gross profit, 45%. Still pretty good for now. All right, let's look at some of their expenses. So their main expenses are sales and marketing, product development, general and admin. Now, this gross profit is decent. However, they have pretty high freaking expenses, okay? They spent 40% of their revenues on sales and marketing. 40 freaking percent. That's pretty freaking high. Compare that to last year, they spent 64%. So it almost seems like because of their decrease in sales and marketing expenses, that's what really hurt their revenue growth, because their revenue freaking crashed 40% year over year. For a growth company, revenue should be growing, not going down, okay? Nothing. I mean, if you're going to have losses, at least have freaking revenue growth. Anyway, so sales and marketing is pretty freaking high. Then you have product development, blah, 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 blah. Total operating expenses are 62% of revenues. So that leaves an operating profit of negative 17%. Wow. And their net loss is 17%. Amazing. Now, let's look at horizontal analysis. So revenue year over year for the 3 months ended September 30th dropped 40%. Cost of revenue went down less, and their gross profit decreased by 45%. Now, that's not necessarily a bad thing, because at least they gross profit, well, it is a bad thing, because their gross profit percentage went down. They were having gross profits of 60% in 2020 for those 3 months, and now they have gross profit of 45%. So they're definitely approaching that mean, that average for the online retailer and brick and mortar retailer industry. Sales and marketing, like I said, they dropped a boatload of money on sales and marketing in 2020 for those 3 months, and they had a pretty steep decline in expenditures as a percentage of revenue, which may have affected why their revenue went down pretty significantly. So their operating loss was 12% compared to 17% in the current year. So their losses got worse. And the best thing of all, share dilution. See down here? 628. 628. Compare that to 108. I don't know, is that million, thousand, whatever. They massively diluted their shareholders by 481%. Wow. That's amazing. Okay. Now, this company is complete and utter freaking trash. Now, let's go look and see a little bit more about what they're about. So, about us, okay? We sell a huge variety of affordable products to consumers all over the world. We are revolutionizing the way customers shop. They're revolutionizing, shopping online. I've never heard of that before. By providing a personalized and entertaining experience that is accessible through all their mobile devices. 90 million active users, still losing money like crazy. 500,000 merchants, 150 million items per sale, and 1.7 million products sold per day. Based in San Francisco. And so far, we lost $2.5 billion. Now, let's go see what the actual marketplace looks like. So I went ahead and created my own account, and I decided to browse. Oh, what's this all about? And the first thing I noticed is this website is freaking sketchy. Freaking sketchy. Now, just look at this. Does this seem legit to you? We go here, we say, oh, diamond ring thing, 75 cents. Massive diamond ring thing, 76 cents. Pants, okay, pants can be 13 cents. And I even found these shoes here, these men's breathable shoes. Let's see, let me view my cart. They were they've cut the price from $200 to $8. What kind of freaking garbage are they selling on here? Like, doesn't this just seem sketchy as heck to you? Look at this, $4 shoes. Let's see, okay. $17 boots. Oh, is that Vin Diesel? That is Vin Diesel, right? I don't know. I always mix people up. I don't know. There's just something. Oh, what's this? Woo! Man, maybe I need that. Maybe I should shop on here. No, I'm just kidding. Yeah, this website is, I don't know. There's just something really weird about it. But you can be the judge of that. So overall, my opinion is this thing is freaking trash, okay? They're an online retailer. Like any other retailer, they have massive competition, okay? Amazon, Alibaba, Shopify, brick and mortar stores, they're getting into online retails too. It's sketchy as heck. Look at all the, just look at this. This rubs me wrong. This makes me want to like take a shower after visiting this website. Free masks, wow. Just not a big fan. And they've been losing money like freaking crazy. So I don't get the appeal of these Wall Street Bets idiots. Maybe they think it's going to be acquired. That's like the only bull case for this stock is maybe they'll be acquired because their share price has dropped so much. And I don't know, the stock price will moon for, half a day when they get acquired. But that's it. I don't know. It's freaking trash. Anyway, hope you like this amazing analysis. I know. Vertical, horizontal analysis. It's like rocket science. Doing some due diligence. Real DD. Not just, oh, it's the future. Anyway, like, subscribe. Tell your friends about me. Y'all have a wonderful day. Cheers.